Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel that helps you save both your money and your time with short, concise, instructional videos. Today we're going to learn what affects the price of an option and how to predict how the value of an option will change given various fluctuations in the market. To be able to make these predictions, we will learn how to use the option Greeks to understand how time, volatility, and probability affect the price of an option. Before we get started, please take a moment to hit that like button and subscribe to help this channel grow so that it can help more and more people take control of their own financial futures. Alright, let's dive in. If you've been following this channel for long, you've heard me define options, but understanding these concepts is incredibly important, so I'm just going to give it to you one more time. An option is a contract which gives the buyer the right but not the obligation to buy or sell an underlying asset at a specified price prior to or on the contract expiration date. Options can potentially give you the right to buy or sell stocks or other assets at better prices than their current market value. It is these favorable rights that are what give option contracts their value as a derivative asset. The exact value of a given contract will fluctuate over time based on constantly changing market conditions. Understanding these fluctuations can be a bit tricky, but we can break the components down that make up an option's value into a few key variables. I guess that now is as good a time as any to remind you that options always deal in increments of 100 shares. You may notice on your trading platform that the prices for options are often displayed as just a few dollars, depending on the stock of course. But this is just the price per share. That means that purchasing an option with a displayed price of 3.5 will actually cost you $350 to buy the contract. This seems a little bit weird at first and can take some time to get used to, but eventually it will become very intuitive because it makes the direct connection between the fluctuation in the price of a single share of stock and the displayed option price more apparent. A $1 move in the stock on the day of expiration will translate to about a $1 move in the displayed price of the option, even though this represents a $100 gain or loss if you own one contract, because that contract controls 100 shares instead of just a single share. At this time, there really isn't a way to trade fractional option contracts, but it is possible that that could change eventually, given the recent shift of many brokers to offer fractional shares of stock for the first time in history. For now, when dealing with options, just always remember that you need to multiply option prices by 100 to calculate your actual capital requirement. In its simplest form, an option's value can be broken into two simple categories: intrinsic and extrinsic value. Earlier in this series, we talked about how an option can either be in the money or out of the money. Out of the money options cannot currently be exercised for a profit and do not have any intrinsic value. So all of their value has to come from extrinsic sources. In the money options, on the other hand, have both intrinsic and extrinsic value. We can calculate the amount of intrinsic value that an in the money option has by taking the difference between the strike price and the current share price and multiplying by 100. So if we buy a call with a $30 strike price and the stock is currently trading at $32 per share, we can take the difference between the strike and the current share price, which is $2, and multiply that by 100 to calculate that this option currently has $200 of intrinsic value. If this ever gets confusing, just remember that a call gives you the right to buy 100 shares at the specified strike. So if you exercise this call right now, that will give you a $2 discount off the current market price per share. So you would only have to spend $3,000 to purchase $3,200 worth of stock. If the contract is currently trading for 3.5, or rather $350 per contract, then $200 of that value is intrinsic, and the remaining $150 of that value comes from extrinsic sources like time, volatility, and probability. If the strike of your call was instead at $34, then your option would be out of the money, because there's absolutely no reason for you to choose to exercise your option and spend $3,400 to buy 100 shares when you could just purchase the stock on the open market and save yourself $200. Now that doesn't mean that this $34 call is completely worthless, because it likely still has extrinsic value. Intrinsic value is really quite simple to calculate, but extrinsic value is a bit more complex because it is affected by multiple variables. The three main components that make up extrinsic value are the remaining time until expiration, implied volatility, and the statistical probability that the option will expire in the money with some amount of intrinsic value after all of the extrinsic value has melted away. Now this is where the Greeks come in. The Greeks can be a little bit intimidating for some people, but they're really just variables that can tell us specifically how changes in any of these three components will cause the price of an option to change. Now, if you're one of those people that really enjoys complex algebraic equations and want to learn exactly how these Greeks are calculated, I'll leave a link to a technical article in the description below. But for the sake of simplicity, I'll just skip ahead to how we as traders can use these Greeks to inform our strategies. The first and most useful of the Greeks is delta, which actually has two separate uses. Delta deals with probability and reacts to changes in the share price of the underlying stock. One use of delta is to represent the statistical possibility that an option will expire in the money. So if you're looking at an option with a delta of 0.65, that means that this option contract has a 65% chance of expiring in the money. Delta can also be used to predict how much the value of an option will change if the price of the underlying stock moves by $1. So if you own a call contract with a $30 strike price and a delta of 0.65, then if the underlying stock increases in value by $1, say from $32 per share to $33, the call option would then increase in value by 65 cents from 3.5 to 4.15. Now remember, this is the price per share, so don't forget to multiply by 100. So one full contract would now be worth $415. The same goes for the opposite direction. If the stock decreases from $32 to $31 per share, then the contract value would decrease by the amount of delta. Generally, options that are at the money have a delta right around 0.5, because statistically there is a 50-50 chance that it will expire in the money. The further in the money an option is, the higher delta will be, because it is more likely that that option will remain in the money before expiration. This makes in-the-money options more sensitive to small changes in the price of the underlying asset. The second Greek, gamma, is related to delta and can help us understand the rate of change of delta as the price of an underlying security moves. In the previous example, if the option had a delta of 0.65 and a gamma of 0.03, then if the underlying stock increased by $1, we can then add gamma to the old delta to find the new delta of 0.68. If the underlying stock increased by another dollar from $33 to $34 per share, the option would increase in value again by the amount of this new delta. So the price of this option would change again from 4.15 to 4.83. Multiplying by 100, the full value of this contract after the underlying stock moves by $2 is now $483 per contract. The third Greek that I want to look at is called theta. Theta can tell us how an option will react to the passage of time. This is often referred to as time decay or even theta decay. If you remember back to my very first video on options, you'll remember that essentially the main thing you are paying for when you purchase an option is time. So generally speaking, the more time remaining on a contract until expiration, the more extrinsic time value that option will have. Theta represents the rate at which this time value will melt away until expiration. So an option with 30 days until expiration might have a theta of negative 0.04. That means that for every day that passes, you can subtract 4 cents from that option's value. Our call contract currently worth 3.5 will be worth 3.46 tomorrow if all the other variables remain the same. Theta will generally increase as the expiration date of the option approaches. Theta decay is incredibly important to pay attention to because it works against option buyers and works for option sellers. If you buy an option with 100 days until expiration, even if the underlying stocks moves in your direction, adding delta value to your option, After holding the option for 90 days, your option may have lost more time value than it has gained from the appreciation of the underlying stock. The last important Greek for option traders is Vega. Vega deals with changes in implied volatility. You already know that high implied volatility inflates option values because many traders and hedge fund managers use options as insurance policies to hedge against risk. But what if an unexpected event happens in the marketplace after we purchase our option that causes implied volatility to spike? Well, Vega represents the amount that the option value will fluctuate in response to a 1% change in implied volatility. An option with a Vega of 0.03 will increase the value of that option by 3 cents if implied volatility increases by 1%. This may seem like a relatively small move, but remember, implied volatility can move by several percentage points at a time in response to any unexpected market event. The last, and likely the least significant Greek variable that is often ignored by option traders is called rho. Rho tells us how an option's value will respond to a change in interest rates. But federal interest rates are not changed very often, and usually only by the very smallest of increments. This Greek will likely not have any significant impacts on your trades, but it's worth mentioning here. Before we wrap it up, let's do a quick example to incorporate everything that we've learned so far. Let's say that we purchase a call contract on Uber with 30 days to expiration and a strike price of $33 for a premium of 1.5 or $150 per contract. With Uber currently trading around $32 per share, this option is out of the money, so we would expect our delta to be below 50. Looking at our trading platform, we see that this option has a delta of 0.44, a gamma of 0.06, a theta of negative 0.03, and a vega of 0.04. Now let's imagine that 3 days have passed and the stock has increased by $1 per share, but implied volatility also decreased by 1%. Let's calculate the new value of our option. Since the stock increased by $1, we can add the delta of 0.44 to the value of our option, and then we can find our new delta by adding gamma to the old delta for a new delta of 0.50. The change in the price of the underlying stock has increased the value of our option, but we have to subtract theta 3 times for the 3 days of time decay that have passed. We also need to subtract vega since implied volatility fell by 1%. All said and done, our call contract is now worth 1.81 or $181 per contract, which is just over a 20% return on our investment, even though this contract still doesn't have any intrinsic value. Now that we understand how to use the option Greeks, my next few videos will dive in on how we can get the most out of all the data that's packed into the option chain, and how to use these Greeks to select specific option strategies. If you have any questions about the option Greeks and how to use them, please let me know in the comments below. Before you go, please leave this video a like and make sure that you're subscribed to my channel. According to the analytics, 75% of you that watch these videos aren't subscribed to my channel. It'll make your life easier and help this channel grow and produce more quality content if you just take 2 seconds out of your busy day to scroll down and click on that subscribe button. I'll wait. Okay, thank you so much for subscribing. Until next time, keep calm, stay healthy, and happy trading.